Hello and welcome back to that One Future CPA podcast. My name is Christopher Dickerson, and today we're diving into a topic that has reshaped the accounting industry, private equity. From billion-dollar acquisitions to restructurings of entire firms, private equity plays a massive role in modern finance. But how does it impact accounting professionals, firms, and the industry as a whole? I'm not sure, but let's break it down. Before we dive into its impact, let's first define private equity. Private equity firms invest in businesses, often taking a controlling stake with the goal of increasing efficiency, profitability, and ultimately selling the business at a higher valuation. They raise capital from institutional investors, pension funds, wealthy individuals, and they use these funds to acquire companies and fund their restructurings. However, unlike publicly traded companies, private equity owned firms don't have to report their earnings to the public, which can lead to both opportunities and, of course, some risks. For accounting professionals, this often means changes in reporting standards, compliance obligations, and even job security. As someone who grew up in the post financial crisis world of 2008, I am, of course, highly aware of private equity firms and their role in the structuring and the destructuring of the economic systems in the United States. I think a lot of people are not aware of how active private equity firms are here in the United States. And because of that, I don't think that the public is aware of some of the side effects of these private equity deals and how those side effects could spread and infect accounting firms that may be involved with other private equity firms. One that comes to my mind is actually Red Lobster, and I know this is kind of interesting, but Red Lobster and other restaurants, chains like those, are sometimes bought by private equity firms. And because a private equity firm, again, is trying to increase profitability and has a goal of selling the business at a higher valuation in the future, they're not always making decisions that make sense in the long term. Again, they're trying to increase profitability for a sale valuation in the near term, 5 to 10 years, sometimes even shorter than that. So some of the actions that they are taking may not be in the best interest of the consumer or the worker, but rather in pursuit of the dollar. So a lot of these private equity firms will buy these restaurant chains and then they will put them in a holding company and charge that holding company rent for the same land that the company used to already own, which puts them in a precarious situation. And again, I think that without diving too deep into a lot of these scenarios, I think it raises questions about if the goal is not public trust, right? If the goal is not to ensure the reliability of financial statements, but rather the goal is to increase profitability and selling the business at a higher valuation, then are private equity owners the right stewards of accounting firms? I think that is the question that, quite frankly, is going to play out in public right in front of our eyes over the next 3 years. One of the most recent developments in private equity's influence on the accounting industry was the Blackstone deal. Blackstone, a global asset management firm, recently made headlines when it acquired a stake in one of the world's largest accounting firms. This signaled that private equity was no longer just targeting startups or underperforming companies. Rather, it was making moves in the accounting industry by looking directly at firm ownership. Now, I want to walk through this Blackstone deal because it's both interesting for the accounting industry, but rather standard in the world of private equity. So in January 2025, Blackstone, a leading global investment firm, as we mentioned, announced a deal to acquire a significant stake in Citrin Cooperman, right? Citrin is a public accounting firm and has some advisory and tax as well. Pretty standard operations for public accounting firms. And this transaction valued the company at $2 billion. Now, this is interesting because this is one of the first, if not the first, private equity to private equity transaction involving a public accounting firm in the United States, at least in recent history. So this is interesting because that first public accounting firm, that first private equity firm, New Mountain Capital, acquired their stake in 2021, which valued the company at $500 million at that time. Under New Mountain's leadership, the accounting firm was able to expand its footprint, acquire other CPA and consulting firms, and this, of course, contributed to significant growth enough to bring that valuation in 2025 up to $2 billion. Now, Blackstone had to be very careful and structure its ownership to ensure that its stake was below 50% to assuade any concerns regarding auditor independence. This is probably the stickiest part of these recent deals is how do you maintain auditor independence when you're involved in these private equity transactions? Now, this is a growing trend. It will continue into the future. This partnership with Blackstone is expected to further enhance what Citron is already doing and make it more attractive for other firms to engage in the same type of transactions as Citron. In fact, we have a list right here of others that did such a thing. Like, for example, Grant Thornton. In fact, Grant Thornton is working with New Mountain Capital since March of 2024. Baker Tilly with Hellman and Friedman. We have PKF O'Connors. We have CRI, Con Resnick, Grant Thornton in both the UK and in Germany. So firms are looking for resources. They're looking for capital, right? Private equity firms are looking for businesses that they feel they can help grow and flip for future profit down the line. It sounds like a marriage made in heaven, but I think there are headaches to come. But there is no doubting that the speed of the velocity of transactions in this space are only going to increase. So we have spoken about exactly what private equity's aim is as a business, and then some recent transactions that have happened in the accounting space. And so let's break down the impact that this is having or can have into the future. So first, increased capital investment allows firms to adopt cutting edge technology. I think that this point is probably at the top of most small and mid firm and maybe some large firm partners' minds because technology is adapting at such a rate that if you're not onboarding some of these technologies, it's not even so much about missing the boat. It's about missing some of the increased efficiencies that allow you to better serve your clients and to grow and acquire new clients. So I don't think it's technology for technology's sake. I think that there's a lot of fluff in the space around Gen AI and machine learning, especially when it comes to what the delta between what people say can be done with this technology and what can actually be done with this technology in the next couple of years, especially when you're thinking about being a small and mid-sized firm who may not have a ton of capital or capacity to get this technology online. A private equity firm's investment in you is, of course, pretty attractive. Also, firms can expand services and compete globally. This is sticky, but true. You can't run from it, right? So by increasing your footprint, right, through the use of greater technology and additional resources, you can compete globally in markets that you may not have competed in. You can expand to maybe, have some workers. It's so funny how much I'm trying not to say outsourcing, but that's just the reality of the world that we're living in, especially for the accounting industry, which quite frankly hasn't done enough to shore up its domestic pipeline. And so companies are being pushed, quite frankly, because of filing requirements, especially for accelerated filers. If they don't have the staff that's necessary to make these reports on time, there are penalties. So there's a necessity to compete globally for some of the talent. And as we mentioned, you can expand services to maybe tax consulting, maybe be able to do some more tax planning. You may be able to, add a different business line, may be able to open up an office in an area where you think you could grow business. And so that investment is definitely helping firms think about ways in which they can better compete on both services and talent. Lastly, there is a more performance-driven culture when a private equity takes ownership of any company, right? So it's not just, well, accountants will be under the whip to be better if they're owned by a private equity firm. That's sort of the reality for any company in that situation, because again, the objectives of private equity ownership is profitability, efficiency, and then, of course, selling in the short term at a higher valuation. So, this means that managers, supervisors, partners will be under greater pressure, quite frankly, to ensure higher performance, which means that those who are performing higher will get rewarded with more work, but also greater efficiency, and those who are not will be shown the door. And that's, well, quite frankly, just the reality of the situation. So here are some cons. Cost-cutting measures can lead to job reductions. Now, I think that when people hear about firms adapting technology, they automatically think about job reductions because they think, well, we won't need data entry, we may not need bookkeeping, we may not, for QuickBooks. This is a different sort of cost-cutting measure because I don't believe that these, and I do believe this will happen. I do believe that when private equity firms own accounting firms, that they will make labor decisions not based upon replacing that labor with more efficient technologies or, I don't know, additional labor, but rather that they are thinking of cutting in the short term to increase profitability for a high evaluation down the road. So I do believe that accountants and CPAs do have to be on the lookout if they're in a firm that's involved in one of these private equity deals about some cost-cutting measures that may be flippant and not based upon data or facts. Second, pressure from short-term profits may compromise long-term strategy. I'm sorry, but the subtitle of this podcast may be pressure from short-term profits may compromise long-term strategy. Because again, if you're a private equity firm, asset management firm, you're not buying an accounting firm because you want to own it. You're not buying it because you love accounting. You're not buying it because you think, yeah, this is a long-term play. You're literally flipping. I used to sell real estate in Texas. And when I sold real estate in Texas, I not only did do homes and existing homes, but also did flips. And when you do a flip, when you buy a flip, like a flip home, you buy that home and you think immediately about selling it. You think immediately about selling it. You make all of your uh, renovation and design decisions based around the fact that you have a date by which you want to sell. So you may not put in the best fixtures, but that's okay because you're just trying to sell it. You may not fix up the yard, but that's okay. You're just trying to sell it. So the pressure from these short-term profits absolutely compromise long-term strategy. If I thought this was a long-term rental, I might put nicer appliances, I might xeriscape the yard, I might put trees, I might put up a fence, right? So if you're a private equity firm and you're thinking to yourself, I'm trying to flip this public accounting firm, are you trimming the hedges? Are you putting up a fence? Are you doing the landscaping? Or are you doing the bare minimum? Putting in formica tile, laminate flooring, white appliances? Are you doing the bare minimum so that you can increase profits in the future? Or are you doing the things that are right by the accounting firm? Again, an open question. Lastly, changes in ownership can impact firm culture and stability. This is for the worker, right? This is for the CPA and the accountant, the bookkeeper to really, really understand is that by being a part of a massive global asset firm, even a private equity firm that's just maybe in the United States or just maybe in North America, will automatically change your firm culture because, again, the orientation of the firm's objectives have completely shifted, right? So those same managers, directors, and partners are now focused on, again, increasing profitability and efficiency for short-term profit rather than culture and stability. So CPAs, accountants, future CPAs, future accountants have to have their eyes wide open for how these changes may affect their work, their life, their balance, their family, quite frankly, everything. So, what is next for private equity? and the accounting industry, it is clear that private equity is not slowing down. The transactions will continue to increase globally through 2025 and into 2026. The influence that private equity has in the accounting industry will only continue to grow. So if you are an accountant, if you're a CPA, or if you're a student who is planning to be an accountant or a CPA, then you need to plan to enter the field with adaptability at the top of your mind. If you're in a firm that has been purchased by a private equity company, then you do have to be adaptable. You do have to understand that there is going to be an increased focus on short-term profitability and efficiency, and you are going to have to adopt. If the firm is adopting new technologies, then you have to be a native user, a SME. You have to put yourself in a position to ensure that you are staying at the forefront of the changes that are happening in your firm rather than being dragged along. I think that developing skills in data analytics, automation, and financial strategy are ways to remain competitive. In just literally the last episode, we were speaking about how technology and the rapid change of that technology has to rapidly change the way the accounting profession approaches the education space. What I mean by this is that there is not a lot of data analytics, automation, or financial strategy in undergraduate accounting programs. What this means is that if you are not teaching students at a very early time in their career, their professional journey, about ways to be competitive in the new landscape, you're graduating accountants and future CPAs that are already behind the boat. So we must put data analytics, automation, financial strategy and planning, consulting, strategic decision making, and soft skills at the forefront of education, or we risk graduating accountants that simply are not ready for the realities of the future. So something to think about if you're in the education space, or if you're in the space to influence what educators are doing, to think about that in that way. Speaking of change, in our next episode, we're going to take a closer look at the role of accounting in the decline of the middle class. I love research. I love to look at history. I love numbers, and I am a member of the middle class. I grew up in the lower middle class. And so for me, this is a culmination of sort of both my interests and my lived experiences, especially graduating in 2008, right in the middle of the financial crisis. So from wage stagnation to tax policy, you would be surprised how much accounting has played a role in shaping both economic mobility and economic stagnation. If you've ever wondered how financial statements connect to a broader economic shifts and terms, you do not want to miss this one. And that's it for today's episode of That One Future CPA podcast. As I mentioned, please go to Spotify or Apple Podcasts, take a listen to the episode, like, and comment. Again, my mom is the only one who has commented so far, so please make sure that you do so. The next episode, as I mentioned, is on both accounting and the decline of the middle class. It will be, I think, a very interesting and illuminating subject for everyone. And so please follow the podcast on Spotify or Apple so you get the notification when it's new. And thank you for taking time to dive into the accounting industry with me. I'll see you next time.